Hello, I'm Jordan Newhouse. Alongside John Richardson, Max Pasterzik, Fei Zhu, and Daniel Castro, we are the team covering Maine foods for Brick and Road Reports at Tulane University's A.B. Freeman School of Business in New Orleans, Louisiana. Through this presentation, we are going to give an overview of Maine, its peers, and the shell egg industry. We will then go over our investment thesis as well as our valuation methods, which, as you can see, yielded a target price of $35 and a market perform rating. Now here's Faye to go over the analysis of Maine's peers and the shell egg industry.
Thank you, Jordan. The shell egg industry is highly competitive. Maine Food is the only publicly traded fresh shell egg producer in the United States. Because pricing of shell eggs is regulated in accordance with the Urner-Barry Index, competition exists between companies in the form of cost-cutting rather than in pricing. Recently, however, there has been a trend of consolidation with the shell egg industry. Demand for shell eggs is stable. General increases in demand for shell eggs stems from national population growth. Abnormal spikes in demand can come from factors such as increased fast food restaurant consumption or high protein diet fads. Within the fresh shell egg industry, the bargaining power of suppliers is low. The main outside cost of production is chicken feed, which consists of corn and soybean meal. Because prices for corn and soybean meal are reflected on a commodities exchange, Maine and its competitors have no power when it comes to bargaining for prices. Unlike bargaining power of suppliers, the bargaining power of buyers is high, but may decrease in the future as demand for specialty eggs increase. The largest buyers of eggs are national retailers, such as Walmart. They have a significant buying power over their producers, especially for products that are easily substituted. Lastly, there has been a growing trend in specialty egg production. The rapid expansion into the specialty egg market is a result of the enhanced margins available in this market. Unlike the regular fresh shell egg market, the specialty shell egg market does not have price restrictions. Because Maine is the only public traded fresh shell egg producer, and thus has no true peers, we decided to compare Maine to companies within the poultry products industry. We decided that Tyson Foods, Sanderson Farms, and Pilgrim's Pride Corporation as its primary peers. Similar to Maine, those three companies produce a variety of protein-based foods and distribute to similar geographic regions. Because the shell egg market is far more consolidated than the meat and poultry food market, Maine has the smallest market share compared to its three primary peers, Tyson, Sanderson's, and Pilgrim's Pride. We also identify the Andersons and Hormel Foods as Maine's secondary peers because they're all in the farm produce industry.
We rate Maine Foods as market perform with a 12-month target price of $35 by the end of fiscal year 2012. Maine is the only publicly traded fresh shell egg producer and has become the largest supplier in the nation. In our forecast of Maine's future earnings, we took into account a few drivers of cost and growth. These drivers included the cost of feed, the price of eggs, and the company's total layers. Maine's future growth and revenue will be driven by expansion through acquisitions, efficient management of commodity market risks, and increased focus on its specialty egg division. Maine's growth in these areas will be supported by its stable customer base. With its strong financial standing and aforementioned growth strategies, Maine's future looks sunny side up. The company has chosen to grow by acquisition over building new plants because acquisitions are a cheaper method of expansion. In addition, because demand for eggs in the United States stays relatively constant, only increasing with population growth, the only way to grow market share in the shell egg market is through the acquisition of a bigger portion of the total supply capacity. The company's acquisition targets include fresh shell egg producing companies that have about 4 million layers in production. The commodity markets drive the price of Maine's largest cost, feed, and also the price of fresh shell eggs. One solution Maine has taken on to mitigate increasing commodity prices has been the production and storage of its own feed, which is made up of soybeans and cornmeal. Therefore, management has stated that Maine enjoys healthy margins even when feed costs are higher. Since 2005, Maine's specialty egg division has grown from 8.6% of total sales to 23.6% of total sales for fiscal year 2011. This rapid expansion into the specialty egg market is a result of the enhanced margins available in this market. These enhanced margins derive from a lack of pricing regulation and allow Maine greater flexibility in the way of product differentiation. Therefore, Cal-Maine has incorporated expanding its specialty egg production as part of its growth strategy. With Cal-Maine's top 10 customers making up 66.9% of total sales, the company has a reliable customer base. The top 3 customers are Walmart, Publix, and H.E. Butt Company. The downside to having such a large percentage of sales to a small number of companies is the amount of power that the buyers can exert over Cal-Maine. To alleviate this risk, Cal-Maine keeps customer satisfaction high. Cal-Maine is able to achieve high customer satisfaction by catering to the specific needs of each company, such as delivering directly to stores for Publix.
Thank you, John, for going over Cal-Maine's investment thesis. My name is Daniel Castro, and I will be going over the valuation methods our team used to arrive at the target price for Cal-Maine Foods. As you can see in our football field, in the past year, Cal-Maine has traded between $27 and $36 and change. The dotted vertical line shows Cal-Maine closed at $34.01 as of November 14, 2011. This will give you an idea of where our ranges lie as compared to Cal-Maine's last price. Our relative valuation metrics gave us the following price ranges for the company. Using price-to-earnings ratio, we arrived at a price range of $34 to $43. Our ranges are significantly lower for our 2 other relative valuation methods. Our range for price-to-book value is $27 to $35, and it is $26 to $33 for enterprise value to EBITDA. Aside from comparables, we also valued Cal-Maine using discounted cash flow and then dividend discount model. While DCF gave us a valuation range of $35 to $44, the dividend discount model gave us a less optimistic range of $27.5 to $35. From the valuation methods described in our football field, we arrived at a 12-month target price for Cal-Maine, which is $35. To arrive at this target price, we examined a discounted cash flow model, a dividend discount model, and a variety of relative valuation methods. For a DCF, we calculated the company's free cash flow 10 years into the future. After choosing a conservative terminal growth rate, we discounted the cash flows back to the present to arrive at a target price of $39.86 per share. After DCF, we examined the DDM model. The DDM values companies by discounting the expected future dividends per share back to the present. Following company policy, we took 1/3 of our forecasted net income and divided that by the number of shares outstanding. The DDM provided a target price of $30.46 per share. Although Cal-Maine lacks true peers, we did take a look at price to earnings, price to book value, and price to cash flow per share, and enterprise value to earnings before interest, taxes, depreciation, and amortization. The relative valuation methods were problematic for Cal-Maine's valuation because of the lack of true peers. Consequently, we did not include results from the relative valuation models in our final valuation. Cal-Maine's peer groups consists of large agricultural companies that do not fall directly into the egg producers subset that Cal-Maine does.
Thank you for going over the details of our $35 12-month target price, Daniel. Although we remain confident in this target, we would like to highlight some potential risk factors that could affect our valuation. The 2 main categories of risk for Cal-Maine are financial risk and operating risk. Here is a short table highlighting some financial information about Cal-Maine and its competitors. We would like to point your attention in particular to Cal-Maine's operating cash flow compared to Sanderson Farms, its most similar competitor, and Pilgrim's Pride. Both of these companies ran into such dire straits that they had to do seasoned equity offerings recently. Cal-Maine's vertical integration to mitigate feed costs contributed to this difference. Next, please notice that Cal-Maine is significantly less leveraged than its competitors. With no new debt issuances planned, we expect this low ratio to continue. Finally, as a result of the strong cash flows and low debt, Cal-Maine has a good Z-score. The Z-score is a measure of bankruptcy risk, and any score over 2.99 indicates extremely low levels of bankruptcy risk. Financially, Cal-Maine is a very strong company compared to its competitors. Aside from its financial position, Cal-Maine's main operation of profitably producing eggs also faces some risk factors. First, as we have mentioned, the entire fresh shell egg industry is comprised of price takers, both for the price of eggs, which are benchmarked to the Urner-Barry Index, and for the price of feed, based on the price of soy and corn. Cal-Maine chooses not to hedge either position, leaving them subject to the very volatile commodity markets. However, Cal-Maine's vertical integration for feed reduces this risk, as does the continued shift to specialty shell eggs. Specialty shell eggs are not marked to the Urner-Barry and have much higher profit margins. Currently, Cal-Maine sells over 60% of the eggs it produces to 10 buyers that include large food retailers like Walmart. Cal-Maine remains at risk if one of these buyers decides to no longer buy from Cal-Maine. However, most companies will have to continue to buy from Cal-Maine because it is the largest shell egg producer in the country. Other suppliers would not be able to meet their demand. Here, we should point out that some buyers boycott egg producers if they do not raise the chickens humanely. Cal-Maine has had limited litigation regarding its treatment of chickens, but believes that it will be unaffected by legal actions. Cal-Maine's continued growth depends on its ability to continue to grow by acquisitions. Usually, companies approach Cal-Maine asking to be bought out, and Cal-Maine purchases them very cheaply. Although no deals are currently in the making, Cal-Maine management does keep large amounts of cash on hand to be able to immediately acquire businesses. Last, Cal-Maine is controlled by a single majority shareholder, Fred R. Adams, Jr. Although unlikely to harm the company, this amount of control in one person should be noted. Adams has shown strong leadership, growing Cal-Maine by orders of magnitude, and dedication to the business, and we see no reason that his continued control would pose any issues.
To sum up our presentation and investment report, we believe that Cal-Maine's current position as the leader and largest producer in the shell egg industry has it poised to continue its growth and generate profits even during high volatility in the feed markets. The stability of Cal-Maine's stock price and consistent market demand makes our target price of $35 and market perform rating very safe bets going forward in an uncertain economy.